All right, what we're looking at here, of course, is just the first shot, the screenshot of the home page of a free trial account. Those of you who are just getting started, I encourage you to make sure you take advantage of the 4 steps there. Take a look at the free quick start guide, the flash tutorials. We host a variety of webinars during the week, and we also have a large library of archived webinars. I'm sure I will reference that at least once in today's webinar. In addition to that, of course, you can sign up for a free coaching session at any time as a trial member and a subscriber. All right, now Jim's question, I didn't have time to write it up in the slides today, this afternoon, but Jim's question was regarding the search. And what Jim does is he gets a list of stocks at 3 p.m. I guess on Friday, or at 3 p.m. every day. And what Jim wants to do is go in and look at a specific strategy, I believe it was bull put credits, with the stock symbol. So what Jim does is he goes into bull put credit and he goes into the search. Now the search in every one of the 23 strategies we support will search across the universe of options and identify only those positions that match the criteria, whether it's our default criteria on PowerOptions, here I have our weekly bull put selected, or if it's one of your saved searches. And what Jim likes to do is he takes his stock lists, but he has some basic requirements. He has a list of maybe 10, 15, or 20 stocks. And he's looking for maybe, let's say, 1 week out trade. So we'll set the expiration to be between 0 to 8 days, or let's just go 2 to 8 days. And might have a minimum net credit of 25 cents, minimum return of 5%, wants to be at least maybe 1 or 2% out of the money, and let's just say with an 80% probability. Strike difference, we'll just say equal to 2. This is just for the sake of argument. Okay, so he's got some basic criteria saved on his search. Now what Jim wants to do is he goes into the fundamentals and he says, I want to run this search, but only on the stocks that came in from this pre-populated list. So let me go ahead and put in Apple. I just want to see the spreads for Apple. So we hit submit. Okay, well there's nothing 2 to 8 days out that matches that basic criteria. I find that hard to, oh, that's why. Let's go 1% out of the money with a percent return of 5. That would make more sense. Let's just take that out. Okay, sorry about that, folks. Put in the wrong symbol? I go 2 to 9. Maybe, oh, I'm sorry, it's the date. It's registering at 8 days. My apologies. What? That is so strange. Let's take this back a notch. Okay, there we go. So there's Apple spreads. Wow, sorry about that, ladies and gentlemen. Nothing had a 5% return that was offering at least a 75, 80% probability. That's why I couldn't find anything. Okay. But now Jim's problem is that he's got 10 stocks. He put this one in. Now he wants to go back and search on ExxonMobil. Well, he's got to go into fundamentals, and he's got to change it. Now his question is, why does he have to do this each time? Well, anytime you run a search, Jim, it defaults to the options criteria on the search screen. Okay, so it goes right back to the options. It won't remember what was the last one you put in. I think an easier method for you is you already have your criteria set and you get your list. Okay, so what you could do, number one, just create your own personal stock list. So I'll go to the list field, I'll go to create list. We'll just click on Create List up here in the corner, and now you can paste all of your 10, 15, 20 symbols in and just screen against those. And you can organize the search results by alphabetical order or by stock price, so you just see all the ones that match your criteria together. The fact that if you're doing spread trades in this fashion, and I don't know what criteria you're using, but you're most likely looking for something that has a reasonable probability, range out of the money, and maybe a minimum net credit, if you're not happy with the functionality there, that every time you run a search, of course, it defaults to the options field, and then you have to change to fundamentals and then go back, maybe you should just use the spread chain. It doesn't give you all of the data that's available, but if I'm looking for bull puts on a particular stock, let's go to the parity view, and I want just anything that offers a net credit of 15 cents, minimum return of 4%, and a probability above 70, or whatever criteria for the next expiration, we just make those changes, and then again we can put in our symbol in the spread chain. Okay, so there's nothing there. Let me go. There we go. There we go. Okay, sorry about that. So you can just do that, and then go to your expiration, and then just put in one stock at a time from here. And then you could go to XOM, for example, or we could go to any series any stock we wanted to. But this would show you the information right here, and then you can see the profit and loss chart. So I'll talk to the programmers anyway, Jim, but I don't think there's any way to anchor the search to the fundamentals, okay? It would always go to the option field and then drop out, okay? And so that's what we would look at in that situation. So you don't want to use the list because it mixes everything together. I understand that. You could go here as well. Just do it from the spread chain itself, okay? That's just another way of doing it there for this position. But I'll see what the programmers can do, but in general, anytime you run a search, it just defaults to the options tab itself. It will not hold on the fundamentals tab where you can just put one stock in, one stock in, and one stock in. Yeah, the search by symbol tool is another way. It just doesn't have the flexibility that you're looking for, right? So if I went to the search by symbol tool, I could put an AAPL, use less results, but it doesn't have the filtering capability, which I know is why you don't use this tool, because it just populates it with several different spread positions, makes it more difficult to sort through because there are no sort filters on this particular one. Okay, so let's move on now. That's the topics there. I'd probably create a list, even though it mixes them all together. I could still filter them by, instead of mixing them, I'd just perhaps filter the sort by stock price or by company name, so that I just have them in order alphabetically, and I can quickly look at the probabilities and the returns there for the group of 4 or 5 that come up on the screen. Right? Okay, so second question came in is from Rajiv. This is related to the married put position, the radioactive trades, and he wants to know how to manage income method number 6, bear call spread done in the context of a married put position. Okay, he says when the short position is closing at strike price as of the current price. Okay, so let's take a look here. Let me just go to a custom spread tool, and I'm just going to put in ATVI. Okay. And let's say that a while back I had bought the stock, 100 shares at $57, and at the same time I had bought a 60 strike put, probably out, well, it might have been January, but I'll just use January for an example. So I would have bought the 60 put at that time, probably at around $6. So about 2 months ago I might have entered this position. So here's a standard married put. I do have $6,300 invested. The 60 strike put gives me a guaranteed exit price of $6,000, so I'm only risking $300 on the investment, or 4.8%. Okay? Now, common approach to adjusting a radioactive trade, well, the first one is that as the stock moved up to maybe 58 or 59, I might have sold a 60 strike call for about 95 cents. Okay, so when the stock was at, let's say, 59.50 or so, I sold that 60 strike call for 95 cents. All right, so now I've lowered my maximum risk to 3.3%, and I still have a potential profit of 2.5%. Right, this is a married put with a covered call against it. Income method number 1. All right. Now, as I scroll up to the top, the income method number 6, Let's say 2 weeks ago on October 1st is when I sold the 60 strike call, but at the same time, I would have bought a 62.5 call for maybe 40 cents. Probably, let's call it 35. Now what this does, of course, it's going to take my premium of 95 cents down to only 65 cents against the position. But unlike just selling a call, which caps the upside, now I have an extra long call on the position, so it still gives me infinite upside, and the risk is down to 3.8%. Okay? Now, where am I at here? I've got a far-term married put, an insurance policy on my stock out to January, but I've sold a near-term 60 call, and I own a 62.5 call. Okay? What does this do here? Well, I'm going to be obligated to deliver shares of stock at 60. And then I'm just left with, oh, sorry folks, just left with a long call and the put position. So how do we manage income method number 6? In this case, really, you just treat it like an income method number 1, Rajiv. What's the issue here? Whether the stock is right at or just below the short call strike price, that's what you have to decide with. This option is going to expire worthless. Okay. Now, at this point, if the stock stays at the same price, I chose the October 13th series. Oh, I hit the 20th. I'm sorry. It should be the same expiration. Sorry, folks. Let's go to October 13th. I'm not just going to change the course of the trade too much at all, but I want to make sure we're accurate here. There we go. Okay, so that's more along the lines of what we're looking for. But we're obligated to deliver shares of stock at 60. So I would treat this just like what we call income method number 1, just having the call sold against it. I may just roll this call up in price and out in time. Okay, apply income method number 2. I could allow the stock to be assigned, use income method number 7 to get back into the trade. Okay, so if this is expiration day, if next Friday this is where the stock is, if I want to stay in the position, I have to roll this call. Don't think of it as a spread. Think of it just as income method number 1. My 62.5 next week would still expire worthless. I have to adjust the 60. How would you adjust the 60 short call against the married put? The same way if it was just an income method number 1. Now, sure, you could liquidate both legs and move the whole spread up to, say, a 63-65 spread if you wanted to for the 20th or for the 27th, okay? Or you could adjust the position by just focusing on the short call, and depending on your SIGA model that's discussed in the blueprint for all 12 of the income methods, decide what adjustment you'd want to make. Maybe you want to do a 5 now instead of a 6. Maybe you want to change it to just an income method number 1 by rolling the call up. Don't think of it as a spread. Don't think of it as a complicated spread inside the married put. Just consider it now at this point, if it's between the strike prices, you have to manage that. You have to manage the short call just as like it was income method number 1. Okay? And then, of course, you can evaluate going into a new income method number 6 as well. Speaking of radioactive trading, radioactive trading concepts is a course position where we start off every position with a stock and put combination to guarantee a limited risk of 3, 4, 5%, like we just saw with the ATVI position. The full work is described in the blueprint. Now, just one moment here. Oh, sorry about that. There we go. So the married put here, we purchase shares of stock and we buy a put option. So even if the stock collapses 20%, such as AAOI, which I will get to for Mark a little bit further on in the presentation after another 5 or 6 question calls, I can't lose more than that single-digit percentage. And we have 12 different ways to adjust this married put to potentially cancel the risk and bulletproof the trade. We make adjustments to where we have no risk on the trade. Even if the stock fell, we would still have a profit. That's called being bulletproof. Now the full tech, I'm answering this for the reason I'm bringing this up, you know I don't normally do a full type of commercial here during our Friday sessions, but the reason why I'm bringing this up is because Arvind asked a question, came into a comment. I'm going to go over to radioactivetrading.com, And Arvind said, I'm learning options now and lost a lot of money in stocks, so what is the best advice? To me, you want to go to radioactivetrading.com and go ahead and get the sketch. Okay, you can register for the free registration site, but get the sketch. It's a free 9-page white paper that describes the advantages of limited risk trading. Yes, it's capital intensive because I am buying the stock still, but I'm buying an insurance policy on the stock as well to control the losses. And rather than just, hey, let's sell a call against it to create a collar, we have 12 different adjustments we can make to generate income, lower that initial at risk as we just saw in the ATVI position, potentially canceling all of the risk, which is a bulletproof position, meaning you can't lose and you can still have unlimited upside profit potential. So if you were having bad luck with stocks, we can talk about stock criteria some other time, Arvind. We can talk about what we use for our bullish strategies, for naked puts and so forth. The covered call picks of the day on PowerOptions have been very successful over the last 2 years, as have the naked puts, despite Mark's issue today with AAOI and maybe some others also with that were in that position. But the limited risk strategy allows you to, even though if you're wrong on the stock, you know you can't lose more than 4 or 5%. I'd like to see you start off now with your options education with something that's protected. And you can look at this and you can say to me, well, this is the same thing I've heard of a long call. If I just bought a 60 strike call on ATVI, this is the same profit and loss, but I'm only paying $4. Right? But you're also risking 100% of that position. If ATVI drops to 58, your call could go to zero. Say, well, it was only $4. I was only risking $400. Well, investors who tell me they don't like radioactive trading or the concepts behind it is because it's capital intensive. They'd rather use the leverage. Remember the lie of leverage. Leverage works both ways. You didn't want to put, let's say, $6,300 into 100 shares in one put of the ATVI position. You have $7,000 of free capital in your account. You say to yourself, I could just buy the January 60 call for about $340. Are you going to buy one contract? No. You're going to buy 5. Or maybe you're going to buy 10. Now you've got $3,400 invested into those 10 long calls at a price of $340. If the stock falls, it's at 61 now, so if it falls 2 to 3%, let's say you bought a November option, it falls 2 to 3% to 58.50. These options that you paid $340 for could be worth 40 cents, 50 cents. If they drop a little bit further, okay, they might be worth 80 cents. But they could drop further. If there's a sudden gap, like we saw with AAOI, these would go right to zero. You've lost the full 3,400. So yeah, I invested 6,300 on a position that moved against me, but even if it fell 20%, the most I can lose is 300 or 3.8%. I'm guaranteed to get that back. Stop order won't help you with that kind of decline. If it's overnight, pre-market, early earnings warning announcement, which is what we saw today. So this is a more protective way. Covered calls are not really a conservative strategy, even though every broker touts it that way. And at level 1 trading, they allow you to do it. Why? Because the covered call is reversed. Covered calls, I'm putting myself in a position where I could make 2 to 3% on the stock if it moves up, but I'm still risking 97 to 98% of what I would have risked on just buying the stock itself. Okay, so you get a little hedge of 3%, but you're still essentially all in. And if the stock was right, if it moved up 10%, you'd only make the 2% from the call that you sold against it. On average, you're going to need to be right 75, 77, 80% of the time long term to make a profit on covered call positions. Okay? Otherwise, the losses come up too quick. One loss could wipe out 5 or 6 previous covered call gains, depending on the severity of the drop. And you say, oh, well, you can keep writing calls against it. Well, I had a conversation with a customer this morning who has IBM. We're just going to take a look at it real quick. He owns IBM at 164 is the average price. And he has multiple shares, almost a couple thousand shares. We're just going to do 100 for this example. Well, IBM is currently trading at about 147. So he's holding a $17 loss on this covered call play. Now, we looked at a month, his thinking is it's just going to stagnate here and move down, and he wants to know how fast can he make back the $17. So he went to standard November expiration and looked at the 150 strike. What's around 190? So if my expectation is that this stock's going to stay around the same price, 147 to 150, and the at-the-money call is going to be worth 190 to $2, we're talking 9 or 10 months of writing the at-the-money call with the highest time value just to get back to break even. Is it worth it for him to stay in this position that long? No. But see, when the stock fell, the $2 premium he was getting, when the stock fell 4 points, it only hedged half of it. And then when it fell 3 points, it didn't hedge as much. He's getting lower premiums as the stock's falling, right? So he lost much more in the stock than he was able to gain on the calls when it went down. He has lowered his cost basis to 164, but if he sells the 150, it's a twofold thing. Number one, if you assume you can sell this call against the stock continuously at 190, 195, or $2, it would take us 9 to 10 months to get back to break even. And the risk is now if it does jump up to 153 or 154, he could get assigned early for a loss, okay, as well. Okay, and so that's just another approach. So what I'd rather like to see you do, Arvind, is focus on the protective positions, married puts and long collars. Now these are sort of like covered calls, but they take a shorter term put in place. So you might be looking to make 2 to 3% to the upside with only risking 5 or 6% to the downside. Okay, so those two positions I think are more protected, and I'd like to see you get into those even though they're capital intensive. The risk of being a stock trader that's lost money and wanting to do options for the higher returns and using leverage is that leverage works both ways, and you can find yourself getting into trouble significantly. Okay. Oh, sorry, going back to the income method number 6 trade we saw with that unlimited upside on the bear spread, Rajiv said if it keeps going, the short position will limit the upside. Yes, but once it crosses the long option, it starts to counter that. Okay. So that's the approach there. So check out RadioActiveTrading.com, download that free white paper and the sketch as well. And on that, FT Trader says, why not collars sell calls and buy puts on IBM? Okay, that's a potential. Let me go back one. You're absolutely right. I could do collars on that instead of this position to control any further losses. But I'm also kind of locking in a loss, aren't I? Meaning that here we got the 190 for selling the call to repair it. Let's just simply do the 135 at 70 cents, so we're still keeping $1 premium. Well, the loss is still significant, and it's not helping me to the upside. The collar's not going to repair this possibility. And another issue there, remember, because the loss is so big, is we can't let it get assigned. What he was looking at was more along the lines of how long would it take him to repair it. So with the collar now added for extra protection, where if it continues down and it does drop to below 140, 135 or so forth, he keeps the loss limited to 17.1%, but now he's only collecting $1.30. Now we're closer to 15 months to be in the position to get back to break even. So that was more of the question that had come in, is how can I get the repair done on the position? How can I get to the position and get back to break even if I think it's going to stagnate? A better answer, by the way, is what we show on PowerOptions here and what's called the stock repair. Now, IBM might not have the premium to do it, but what stock repair will try to do is build you a ratio call spread. And the ratio call spread, 164, and let's just do 100 shares. Essentially, this turns it to a covered call with a bull call debit spread. So here, same thing. The first repair that's available that helps us get back to break even that's available right now is going out to September 2018. Still about 9 months away. But what this does, we'll just look at the trade here. We'll look at the profit and loss chart. What the ratio spread does, I'm going to sell 2 higher strike calls. In this case, this September 155s for 535. So we're going to get $10.70, and I'm going to buy a September 145 for 990. I own 100 shares, and I sold 2 calls against it. 1 call is now covered by this extra long call that I received at a credit. All right, we get a credit of $1, 80 cents actually in this transaction. It's not huge, but we see here the new break even is 154.10. I don't need the stock to go up to 164 now. I can break even at 154.10 at September expiration. 11 months away. Still about the same as selling at the money covered calls month by month by month, or trying to roll them on the position. But a lot of times, if you have a lower loss in the position, you might be able to use the stock repair tool to help you get back to break even faster. Here, we don't need the stock to go back to 164. We need it just to go to 154 by September expiration as well. All right, that's the stock repair tool. And so it's a good way to go, and it's a way to help you get back to that position also. Help it get back to break even a little bit faster. Okay, all right. Now, so that's the ratio spread. One more quick thing on the ratio spreads here, the stock repair. For anyone who has a stock that's currently down in price, I encourage you to go to powerop.com/webinars.asp. That's the free webinars page, okay? And on the free webinars page in the options concepts, there's a webinar here called Manage Your Broken Position. And here we discuss the alternative methods for managing a stock position that's fallen in price, a covered call position that's moved against you, managing a naked put that is now in the money or the stock has been put to you, and a little bit on bullish spread. So that's managing your broken position also, okay? All right. So yeah, the collars was a good idea to help the downside on the IBM position, but remember, it's lowering the net credit. So it would take you longer to get back to break even, but if the stock continued to slip, you would control some of that loss. And that's what I like to see with the married puts and the collars. Okay. Still got a lot of questions there. Jerry says hello. Okay. And Bruce asks, can you scan for volatility skew between weekly option expirations, such as at the money option on Apple between week 1 and week 2? You can see it, but it is not available in the search screens, okay? That is one of the signature tools. So I can go into volatility skew, and I'll just do AAOI, for example. And what we want to do, of course, is the strike skew, not the time. We want to look at the, oh, I'm sorry, no, you do want to look at the time skew. My apologies. And the 48 strike, which is at the money now. And so we can see week 1 to week 2 here, 1013.34, 0.65. It's only giving me those two. I'm not sure why. So let's try a different position. Let's just try Apple, for example. So the at the money 175 strike. Next week's the 13th is really low volatility, 0.5, jumps up to 0.14. And then the following week is 0.16. Why the huge gap? Because the earnings are on 10/17. All right, for Apple. I was looking that up earlier, I think. October 17th. So the 13th aren't even going to be affected. It's everything afterwards. But this is not available in the search function, Bruce. I can search for implied volatility ratio, but that's just related to the implied volatility of the 2 current expirations in a spread, or the IV over HV ratio, not the skew. That's not available in the search. But if you wanted to see what the 1 week to 2 week skew is by strike, just go into signature tools, go into volatility skew, and you've got that right there. Oh, Jim, I'm sorry. Real quick back. I'll mark that down, Jim. I'm sorry. There's so many questions that came in during our conversations, but Jim said the way that I mention it using the spread chain tool, going back to our first conversation and looking one stock at a time, does not incorporate open interest. Okay, well, I'll take a look at that. All right, I'll talk to the programmers about that. Okay, I think my next question before Mark's question is from Mike. And Mike says, does PowerOptions have debit spreads listed? Yes, we have search tools for the debit spreads as well as the credit spreads, the bull call debit and bear put debit. If so, can you show us what stocks would come up with in the money call debit spreads? Sure. Go to other strategies. I'm going to take out long call for the time being. And I'm going to add bull call debit. You see all the strategies that are supported here in the search. So if you're looking for a strategy on your trial or your PowerOptions account, you don't see it, click on other strategies, you'll be able to find it. All right, so now that's added. Save our configuration. I don't know what save search I last looked at on bull call debit, but let's just click on search. YY 9322, a weekly 90 to 87 strike. Okay, and then we've also got Restoration Hardware, Skyworks Solutions, Wynn Resorts. Criteria that are being used, well, we want to be at least strike difference greater than 1, percent in the money greater than 2, percent return greater than 2. You can customize these, probability there. And we're looking for stocks trading above their 50-day moving average, greater than 5% earnings per share growth, earnings not between now and expiration. I may even consider adding a MACD into this particular screen. I'm still doing some testing on the the monthly bull calls and the weekly bull calls as well. The one thing I might change that I've done in the past is looking for a MACD crossover where it's crossed over up to a positive signal sometime within the last 3 days. Okay, so this takes it to Caterpillar, Colgate, Duke Power, and more. And you can also reverse that to look for ones that have a more extended MACD growth where they've been over, the MACD's been over the signal line for at least the last 3 days. Okay, but without the MACD consideration, let's go back in. And by the way, if I was using weeklies, I might use the SMA 20, but you can customize that any way you want to. There were 227 results, which is a little bit too much. 7 days out on the bull call debits for these particular positions. So Facebook came up, Lumentum, C-Trip, Expedia, EA Arts, still hovering around the 119, 120 range. Salesforce is there. Alibaba is there also. Okay? So just go into debit spreads, go into search, and then you can take a look at it. All right, Mark's dilemma that he emailed me about this morning. It was a position that came up in the naked put picks of the day, and the stock was AAOI. And earlier this week, I'm sorry, let's go to custom spreads. Earlier this week, Mark had entered into the naked put that came up for today's expiration, the 13th, I believe, and he sold the 53 put for 90 cents. Now you did 10 contracts, I think, or more, but I'm just going to put it in at 1 to keep the math simple. AAOI does the thing that one of the reasons why we still know that there's risk with naked puts and covered calls. And it was a good premium, but we know there's risk with these positions because something, the unexpected, can happen. That's why it's better to sometimes do married put positions or collars. But in any case, what did they do? They came out last night and essentially stated that their earnings for Q3 was going to miss drastically because they weren't getting the numbers that they needed from their biggest provider, which I believe was Amazon or something, or maybe it was Apple, I can't remember. But anyway, they were missing Q3. Trading was halted. When trading started back up, it was down to $45.50 per share, $46 or so. Okay, and it moved back up to 50 during the day, but then it ended up right down where it was. So now Mark's in a position where he's going to potentially be obligated to buy shares of stock at 53 that are currently trading at 47. Are there any opportunities to roll the position? Well, it's an even 6 points right now. So at intrinsic value, if we bought it back at 6 points, we would have lost $510 per contract, or $5,100 it looks like. Okay? Are there ways to manage it? Yes. First thing you always do, as you're tracking positions in PowerOptions, whether you do it manually or do it from the search or you do it from here, we want to add in this position to our portfolio. And we'll call it AAOI okay, let's call it Friday the 13th, chapter AAOI. Okay, because it is kind of a disaster in a horror film. All right, so I'm going to add it to our portfolio. First thing I'm going to do now is I'm tracking the position. There's no stops that, you're right, there's no stops that would have helped this. No trailing stops. Nothing along those lines, okay? So what we want to do is click the Edit More Information button, go to Position Actions, and then Position Analysis. Of course, we have a breakdown of our current position. Currently have a loss of 10.4% liquidation, and at true expiration value, it's 9.6%. Even though it's expiration today, here were some of the rollout opportunities that were shown. Now, he could buy to close the 53 put at 640 and sell the 52.5 at 590. Now, that would get him back to a positive result. Remember, we took 90 in. We have to pay 640 to buy to close this option back, or close to the $6, and then we could get another 590. Well, right away you see the problem. This is shown as a positive roll because it's taking a loser to a winner if and only if the stock goes back up to above 52.5 next week on the 20th of October. Or on the 27th, goes back above 51.50 or 52. Right? That might not be the expectation. There are other opportunities further down, particularly with the stock at 47. I could buy to close the call at 640, so we have a 50-cent loss. I'm sorry, yeah, we took in 90, we're buying it back. 640, we sell this at 60 cents, so we have a new positive premium of 50 cents or a 1.1% profit now instead of a 10% loss. It is out to December, but when you look at it side by side, this is in the Simulate Trade feature when you're viewing an analysis, we can see here that we've taken a loss of 10.6%, rolled the put down, and if it does settle and stays above 45, it can make 1.1%. Okay? We've actually already reviewed a couple of the other adjustments as well. And what I mean by that is that another opportunity for this position, in addition to the rolls that are shown where all the math is done for you, like we talked about with the IBM position, you could take assignment. You do have a cost basis of 52.10. Well, you could sell 48 or 49 calls against it to help you get back to break even. Or you could take assignment on AAOI, and do the stock repair. I got 90 cents for the 53 put. I can go ahead, say that I own the stock at 52.10, again 100 shares to keep the math simple. Here's some implied volatility where I only need the stock to go up to 48.20, 47.85, 46.90. These are still out to December or January. There's no magical fix that you can repair this by just going 1 week or 2 weeks out. And Mark, I know you're not asking that. But still, if I took assignment and owned the stock, I could do the ratio repair, and I could go out to March and have a break even of 46.90. Or go to January, and if the stock stays at 47.85 or so, on this position with that repair, I'm sorry folks, here we go. You're back to break even, and you can still have a heck of a return to the upside if it does go back above 50. That's if you took assignment. So those are some ideas of what you could consider. I showed you the rollout opportunities. You can use the position analysis tool to analyze that. And then, of course, you can compare the position side by side using that Simulate Trade feature to see which one best suits your needs. Agreed, I probably wouldn't sell the 50 or the 51.50 or the 52.50, even though they are positive, profitable adjustments, unless you felt that this was an overreaction and it's going to come back up in price. Okay? All right. Oh, I'm sorry. I think I made a mistake there. I was thinking of IBM. FT Trader called me out on that one, or mentioned it to me. Apple's on 11 too. I think I said I think I had mentioned that it was on 1027. That was for IBM. That's where the 1017 earnings was coming out. I think Apple's on 11.2. Okay, so you can just look at the volatility skew there going across those also using that volatility skew tool, okay? And yeah, with a decline like that, Sam also said if you wanted to, you could purchase the stock and then sell more puts at a lower strike and sell a call, sort of like a covered combination in that situation if you think the drop was over. I can't give direct advice on a particular stock, but you'd have to analyze AAOI. All the repairs I showed you are based on the stock stabilizing or moving back up in price. Okay? If you think it's going to continue down, that the market's going to continue to hammer it, you've either got to switch this bullish position that you're in, it's losing money, and then change it to a bearish position, maybe a bear call credit spread or something along those lines. If you think the stock's going to decline, or just buy a put, but it's going to be expensive because we also have the volatility in that position as well. Okay, all right. Okay, Mark has another comment related to the radioactive trading position real quick. I think there's two more comments, and I'm at the point in the webinar where I have to sort of skip through the questions to try and get the ones that come together. Another position that I had a discussion with a customer with today relates to Mark's follow-up question on the married put positions. I'm going to flub the specific numbers, but I'm going to do my best. And I bring this up because someone also mentioned BABA in this position. So let me enter a married put. And, I'm sorry folks, BABA. 100, let's see here. I'll select the option. It's at 178.45. Good. Real good. And the January 19, yeah, this is January. 190. I don't remember the exact date. Okay. Let me think about this. Nope. It was 173. All right. So he did a shorter term put, and he only went out to January with the married put. And something's not right. You know what? It was. I'm sorry, folks. I'm just trying to get the math right in my head. Edit position. I couldn't remember his price. It was around 174. It was 174.20, I think. That looks right to me. Okay, that looks better. Good. All right. So in the married put position, his stock's up 425 or 2.4%. I say, oh no, the put's down 8.9%. Yeah, but it's only down $1.70. So he's got a 2.4% growth in the stock, and he's still making 1.3% on the position. Yeah, the put costs money, Mark. You lose on the put if the stock goes up. But done in the proper structure, which we teach in the blueprint at RadioActive Trading, you're still going to make 50 to 60% of the growth in the position. And with this structure, the maximum risk was really small. I think he actually legged in this position why the risk is so small at 1.7%. But if the stock falls 20%, such as AAOI, most he could lose is 1.7%. Okay? So yes, you give up something, but done in the proper structure, you're still going to make 50 to 60% of the growth of the stock. And at the same time, that just means that as much as the stock goes up, you're always going to be losing less on the put. You're still going to lose something, but it's never going to outpace the gain on the stock. Unless you hold it, you bought a 6-month put and you hold it for all 6 months, and all time value would decay, but you likely would have adjusted, rolled, follow the rules in the blueprint to control that risk and get it to bulletproof status well before you held it to expiration. Right? That's one of the rules in the blueprint as well. So yes, the put does decline, but done in the proper structure, it always declines less than the stock moves up. You're always making more on the married put. That's why you just look at the profit and loss chart, and you can see that. You're always positive. And sure, the put could go to zero. What would I need to have to happen for this January 190 put to go to zero? Well, the stock would probably have to be trading at 230 or 240 sometime in December. I am fine with that. I have a $60, $56 gain on the stock to lose $19 on my put that was hedging it so I could only lose 1.7% if there was a rapid decline. I think I'm okay with that. Okay? So yeah, the best insurance is expensive. You do have to pay to get the best insurance to keep the control to single risk. You will watch your put decline in price if the stock moves up, but you're always going to be making more on the stock than you're losing on the put. You're still always going to make 50 to 60% of the expected move on the stock, okay? Okay, Rajiv, follow-up question on a declining stock. Let me just take something, Rajiv, before I get to your next questions, okay? All right. And Paul, I see your questions. Jim mentioned, going back to the AAOI example we were talking about, Jim says, seeking alpha suggests 2018 growth should be very strong, likely a lot of short covering on this negative catalyst and some fresh money buys. Recommend buying the dip. Okay. I don't know if I agree with that because it doesn't look like they're getting new vendors at all. It doesn't. Their discussion today in the news article that I read said that they were going to miss their Q3 earnings, but they're not expecting to gain much more from where they are with new clients and with new customers and with new growth. That's what I read. They're not expecting on that. Okay. All right. Another position on AAOI idea that's available on AAOI. If the stock has fallen and you put the stock at 53, you could buy another 500 or 1,000 shares at $47 where it is now to average down and then do a stock repair. That's another idea, okay? Mike C. Okay, hold on one second here. I'm going through these. All right, Mike C. says, does PowerOp present daily opportunities on various spreads or married puts? Well, I don't say, we don't make suggestions. But if you're asking me if I was opening a married put today, what position would I open? It's going to be from this list. It's going to be from the RadioActive default criteria, exactly what I showed to the Fusion subscribers. At RadioActive Trading, the Fusion subscription is sort of a continued learning annex for those who bought the blueprint. There's lessons and other tools, and Ernie and I post our real married put positions to the Fusion subscription. The one I was looking at this week was TAL. Buying the May 40 put for only having a risk of 6.5% with earnings coming up in, I think, 13 days. That was one. Some of these were negated for me. Alibaba's out, China Holdings out because of my account size. I don't go higher than about $75, $80 per share. But these search criteria, the default search criteria, and these are what Ernie and I select from when we're opening a married put. In the bull put credit spread, we did a series of webinars back in August on credit and debit spreads. And if I was to open a bull put credit spread today, it would come from the weekly bull put list, which we've back tested over a 2-year period, and we tweaked the criteria to find what criteria worked best over this 2 years period. And that's exactly what you're seeing down here in the bottom of the search. It's 8 to 17 days out, because on the bull puts I found that if you went just 0 to 7 days out, you went 1 week out with the same criteria, your portfolio over those 2 years had a loss of 72% from your starting point. Believe it or not. The weeklies didn't pan out, but if you go 2 weeks out, it's flipped. You actually had an 85% probability, or 85%. I say 85%. People disagree with me. Here's why. A testing I did, took a $100,000 account, made sure to allocate only 20% of that total account in the testing, $20,000 roughly, to bull put spreads. You say, why wouldn't you just invest the full $100,000? Because the nature of leveraged spread trades, just like buying leveraged options, if there's a bad month right off the bat, you could lose on all of your positions. Whether you did 5 or whether you did 10, if there's a sudden hiccup for no expected reason, you could be bankrupt. That is a possibility if you invest your full account into spreads. My opinion, conservative view, you should only use 10 to 20% of your portfolio to trade spreads positions because of that lie of leverage. So, taking the top 3 positions, allocating, roughly about $6,600 into the top 3 positions, ended up being an 85% return, meaning that the $100,000 account grew to $185,000 over those 2 years following those rules. So I say 85% because that's what you grew the total portfolio. But you could say you made 400 and X% off the 20,000 because your 20,000 went to 85,000 on the bull put spreads. This is the list I would choose from. And if I went to bull call debit, I would choose to go maybe with the initial values or the monthly. I might do the weekly too. And then for certain strategies such as covered calls and naked puts, we do offer the monthly and weekly picks of the day. Ernie tested these to maximize returns, right? The original 1-year testing was done. You click here to see how he developed these results, and he goes through the whole listing of what he did and the 1-year test period. I'll have this updated on Monday for you, where we have the testing of all of the picks of the day, plus the bull puts from June 2015 through September 18th, 2017, last month. Okay, so we'll have those numbers for you updated on this screen. So there are opportunities that you can find left and right. And if you asked what position would I enter in a married put right now, it's going to be one from this list. How am I going to call down that list? Well, the first thing I'm going to go to fundamentals, and I have to have it match my stock price requirements for my account size. Narrowed it down to 14. So I'm going to pick the one that I'm already in. Planet Fitness is a married put, by the way. I was looking at TAL, as I mentioned. Ernie's in FCX for the Fusion portfolio. He might also be in Five Below, I think. And of course, AMAT is always an interesting one too. Okay, so that's the whole point of this tool. Is we give you tons of ideas, and we show you the criteria we would use to get into a position as well. And that's what's shown in the search results, and then you can fine-tune it from there. Okay? All right. Okay, oh, one more thing here. Sam mentions on this, he says, rule on naked put advice on less volatile stock, don't do drug stocks and also volatile ones like AAIO. Yeah, you know, he was once cremated, he was tempted to do it once, but he was also cremated on it. On that naked put, and it's good advice, and I've mentioned this to Ernie, but he wanted to stick with the testing, and I might do other testing on that too. Oh, I don't have naked put here, I'm sorry, but on the naked put picks of the day, in that description field on both the front and the back, we do mention that if a result comes in, Ignita might be a little bit high, mid-mex group, but if you see something that looks almost too good to be true, in the covered call, for example, we had one last week, which was OTIC. 2 weeks ago, OTIC was offering about a 40% downside protection and a 50% if assigned for an at-the-money 18-strike call 1 week out. That's too good to be true. We showed how to enter it as a collar to be safer, where you would make 50% on the upside, you still might make 14 with only risking 13% if the stock fell. OTIC fell to $2 per share. Okay, but for these ones here, when you see the high return will generally mean high risk. For biotech and high return selections, consider going deeper out of the money or entering it as a bull put credit spread, so you can hedge some of the risk on the position if there's a catastrophic decline. Okay, that's mentioned there in the notes for the weekly ones. And for the covered calls, it mentions doing it as a collar. Okay, so that's a good point, Sam. We show them because they match the criteria, and they were tested. There, Mike, I'll get to your question, your final question, Mike, in just a little bit. Yeah, okay, so it's that. Now, let's move forward here. Going through all the questions. FT Trader says married put, talking about the married puts again, he says married put acts like a stop loss. Well, it's better. Because in the case of AAOI, if I had bought AAOI at 54 yesterday and put a 5% stop order, this morning I got filled at a 20% loss. Stop order can't prevent that. If I had bought AAOI at 54 and bought a March 60 strike put and had a 6% risk, when the stock fell 20%, I can close it right now for 60 and only lose that 6%. It can't be broken. It can't be violated like a stop order. That's the benefit of the married put. It does cost money as well, you know, and that's right. And this AAOI might not have been the right one because it would have been really expensive to enter a put on AAOI because of the volatility, but it also would have protected that as well. And you say Louis Navalier had downgraded AAOI. Okay, I didn't know that. I missed that in the write-ups there. Okay, all right. Okay, let's see here. Is Mike... Oh, am I actually caught up there? There's Paul's question that I wanted to get to. Let's see if I was one more before yours. Oh, okay, no, it's Paul's and then Rajiv's, I think, is it? Oh, no. Okay, hold on. Euclid says he only does option spreads. He buys at or in the money option and sell an out of the money option for the same day. I frequently do not make as much appreciation for the long option as I lose on the short option I have to buy back, right? For instance, have a long position $3 less than the market price and I'm short an option which is $2 higher than the present stock price. Yeah, so in that case, if they were calls, if you were long the lower one and short the upper one, you'd be in a bear call spread, okay? But if I were to close both positions today, I would lose money. Yeah, I think you're just talking about a bear call credit spread. I'm not clear by your discussion if you had a question there. You know, that's the kind of approach you do. You're doing spread positions and you have a strategy for doing it. You're doing it kind of straddling the stock price, okay? And it's going to be a lower success rate, but if you have a management in place where you can adjust it, then maybe that can work. I'm not sure if you had a question in there, Euclid. That's what I'm kind of missing. I didn't see a real question in there in your comment. Now, Paul, going to spreads. I'm going to use ATVI as another example real quick for today. And Paul says, what do you do in the case of a credit spread if the price of the underlying stays between the strikes and only the short leg is in the money and gets exercised? Okay? Let's say I had been bullish on ATVI and I had sold the 62 put for 80 cents and some time ago I bought the 60 for 15 cents for today's expiration. All right. Well, now we know the stock is 61.08. It's right between the two strike prices. As I'm getting closer to expiration, what are my choices? Well, I have to do some management. Okay, so today I would have decided, am I going to buy to close this? Well, I am. Maybe not. Am I going to buy to close the put and take the loss? Am I going to buy to close this, maybe let the 60 put expire worthless, and then, did I do calls? That doesn't matter. And then roll it out to roll down the whole spread. Okay, would I do it that way to the 20th where I'm now trading maybe to be trading the 60 put and maybe buying the 58 or something? Okay, would I roll the whole spread down to try to turn it into only half of the potential gain but avoid the loss I'm taking right now? Okay, so I could just close it and take the loss. I could roll the spread down in price. If I'm already close to expiration, I can't do something we like to call the pendulum adjustment, where I'd sell to close my 60 and buy to open a 64. So in one move, I change my bull put credit spread to a bear put debit without even touching the 62 put, and if I can still make a profit to the downside if my sentiment has changed. Okay, it's called the pendulum adjustment. If you still had time remaining, you could maybe just buy to close the short and leave the long open if you think the stock was going to continue down. But your three choices here, when you're right at expiration, you've let it get this far and you haven't adjusted it yet, is close for the loss, close and roll the whole spread down to try to manage the position. You know, you'd get a lower position, you'd lower your strikes, and this is a bull put. If your sentiment has changed, of course, you could close the position and then open a bear call credit spread for the next month, maybe 62 to 64. Or if it happened that you got assigned, what do you do? Well, we already talked about that, didn't we? Look at it this way. If you got assigned on the short put because it was between the strike prices, Paul, and it didn't move, well, what do you have now? You took an original net credit of 65 cents. You bought at 62. So you own 100 shares of ATVI, the cost basis of $61.35, right? 65-cent net credit, 62 purchase price of assignment, and now we're not looking too bad. It's $61.35. The stock's at $61.08. So now I could convert it to a covered call. Let's sell the 61 call against it, cost basis of $61.35. Okay, now I can have a 1.6% return if it stays above 61. You could do the stock repair that we showed. You could do a collar that we talked about on the position if you're worried about more downside. So if you end up getting put the stock from a bull put credit spread, sorry, as well, then you can manage it different ways, convert it to a covered call, check out the stock repair as well. If it's the reverse, if it's a bear call, now it's a little different, right? If you're in a bear call and it was between the strike prices and you didn't close the short call, well, now you're short shares of stock. So you could convert it to what's called a covered put, or you could convert it into a short collar, for example. Okay, you can do it either way as well. So that's one of the things. If you end up getting put the stock, just treat it, as we already talked about a little bit today, we touched on today, just treat it as a long stock that maybe your cost basis is above the current stock price. Evaluate it as a collar, a covered call. See if you need to do the stock repair on it to help you with that, or add a put to protect further downside losses. Or just close the stock if you didn't want to own the stock, okay? So that's another idea there. All right. Okay. Oh, Mike asked a follow-up question. What's the difference between Fusion and PowerOpt? Okay. Fusion allows you to, well, PowerOptions here, what you're showing is we support tools for over 23 of the commonly used option strategies. PowerOptions is really designed for self-directed options investors, but as I mentioned, we have default searches you can use as a stepstone to find positions that match your criteria. The Fusion subscription, you can follow my trades and Ernie's trades in the RadioActive Trading techniques. Okay, it's not an advisory service. For investors who buy the blueprint who want to follow the technique, we show our trades to help you see how you could trade this in your personal accounts and how we use these adjustments in real time. We don't recommend using it as an advisory newsletter service. It's more of a learning tool. So that's the open trades. A Fusion subscriber also receives several lessons that they can go through, which emphasizes the material in the blueprint. There's a basic search report, the RPM report, similar to what's shown on PowerOptions, the Married Put, and the stock insurance tool to help you lock in profit, and then members-only webinars and white papers. The concepts, the trades, the ideas on Fusion only relate to the Married Put structure. Every trade has a stock and put combination, and then the 12 different adjustments we use off of that initial structure, whether it's adjusting the put, doing one of the riskless spreads like income method number 6 we saw earlier in the webinar, or more. Fusion just focuses on the radioactive trading techniques. And yes, the RPM report does give you trade ideas. Same list: Netflix, Guideware, TAL, Freeport, China Loading, Alibaba. It's the same thing we saw in PowerOptions. It's using the same search. Okay, but it's limited. It doesn't allow you to make any adjustments, and you can't do covered call screens. You can't do bull put credit spread scenes. The tools here and the education here is just focused on the married put structure and the 12 different income methods we use off of that. Whereas PowerOptions is your one-stop shop for self-directed investors, where we support over 23 of the commonly used option strategies. Okay, Rajiv had another comment on a GE. He owns GE at 24.05, and now GE is down to 23, so it's a $1.05 loss. So should I create a married put here or do a stock recover? Do the stock repair. See what comes up, Rajiv. See if it matches your goals and your expectations for the stock. I'll say if you're concerned about more of a continued downturn, then you may want to add a put to protect the position, or exit it and just buy puts if you think the stock has moved to a bearish trend. Adding a married put, converting it to a married put now is not a bad idea, but remember, if I opened a married put on GE today, I might only have a 3 or 4% risk. If you open a married put on GE today based on your cost basis, that maximum risk might be much higher, okay? Because you've already accounted for the $1 loss. Sorry, folks, I forgot to turn the phone off. My apologies, all right? So that's where we are with that scenario. Run the stock repair first, see where it is, and then go ahead and take a look at what you could get, okay? All right. Yeah, let me log on here. The results we show, it's a thing here. So here's, you can go into the track record for myself or for Ernie as well, in addition to the open trades. And for Fusion subscribers, they see all of the description. Now you can go here, and if you, when you pick up the sketch, you'll be given a password that you can access some of the additional tools. But you can see here sort of the track record is 66 total positions Ernie's had. He's a 50% win-loss ratio, but because of the controlled risk, he averages a 10% gain on the winners, only a 5.4% loss on the losers. Again, we don't show it as a portfolio. There is a customer in Fusion right now who doesn't like the way we display it. And the reason we're not showing it as a portfolio of what was our gain or loss in each year is because this is not designed to be an advisory service. This is designed to be education. You can see Ernie's returns on the positions. You know, here he took a 22% loss and only lost 11% on the married put. Some losers, some big losers in there as well. But it shows you all of the track record. But up here you can see that he's right 50% of the time, makes 10% when he's right, and only loses 5.4 when he's wrong. With a 50-50 win ratio, a $10,000 account over 100 trades would go to about $62,000, $63,000 with a max drawdown of about $9,400. Now he's only at 66 trades. Mine is subtly different. My gain on wins to loss on losers is closer, but I'm actually right about 60% of the time. So I think I make 6.8% when I'm right and 4.8% when I'm wrong, but I'm right about 60% of the time. Okay, so it gives different numbers based on the simulation. But we're not showing, we show our trades. We do show our trades, but we don't show it in a portfolio of, oh, if you did this, you could average 10.1% return on average per year. That's what we expect, and that's what Ernie and I see in our personal portfolios, but we don't show it here on the trades because we don't want it to be looked at as an advisory. What most customers do that are interested in radioactive trading, they buy the blueprint. That gives you a bonus free month of Power Options when you pick up the blueprint, and your first month of Fusion for only $10. It's about $60 a month after that, $69 a month after that. What most investors do is they go to Fusion first. They take that discount $10 first month, then maybe go to a second or third month. And then once they feel they're comfortable with the extra lessons that they have and they feel comfortable with the blueprint and going through the trades and seeing when we reacted, when we applied what income method to a position and so forth, then they'll move over to Power Options and they'll start doing it themselves with the portfolio tools and also with the search also. Jim, no. Jim asked a question just about the basic Power Options page itself. He says, has the programmer considered adding more tabs at the top so I can have more strategies to choose from without removing and adding? No, we haven't, because we don't have the space, and then when it layers like that, it has issues. So when you create a second list of toolbars here, it makes it harder to navigate the site with more added to the view. And the last time we did a survey, 95% of the people that did the survey last year only operated 5 strategies or less. So we allowed it to go up to about 7 strategies with our other tools that are put in there. But 95% of Power Options is not doing more than 7 strategies or evaluating more than 7 strategies at a time. But again, Jim, let me write that one down too. Okay, does not open interest on the spread chain and more tabs as well. Okay, I'll mark that down. I'll talk to the programmers on Monday. All right. Okay, Sam mentioned he thinks he has a GE. GE might have a problem with management, might need some correction there. It's true, okay. Oh, you've got to be kidding me. Wow. I'm so sorry, Mike. I'm so sorry. Let me go back one. My apologies, ladies and gentlemen. Let's go back here. Here are the tools that are available in Fusion. The Fusion lessons I mentioned, the open trades where you can see the positions that Ernie and I are in. He's bulletproof on 3 of his 5 trades where he has no risk. I'm bulletproof on 1 and haven't made an adjustment on Planet Fitness yet as well. And then the track record, that's what I was showing you. My apologies. So for Fusion subscribers, you see the entire track record there. 1 second. There you go. So 66 total positions. 33% winning, 50%. Average gains, 10.1% on the winners, 5.4. And again, we show it as a simulation. If after 100 trades, Ernie keeps the same win-loss ratio in the gains-winners, a $10,000 account would move up to about $56,000 and may have a drawdown of about 17%. But again, you run it again, you get sort of different numbers in that scenario based on the number of wins and losers. That's a trade simulator tool. So we're not showing it, as I mentioned, as an advisory. as well. Okay. All right. So you're okay. There we go. All right. So that was the fusion. But as I mentioned here, that's just that part. Every trade and every transaction that was made by Ernie, myself, you can go through the list here. All right. So the Fusion subscribers can see all the trades that were entered, when they were entered. Click on View Details. And you can see all the income method number 4, income method number 1, number 2, and so forth. And each time we post a trade, whether it's open or whether it's closed, we show a brief for that. Why did we do it? What was the adjustment? What was the thinking? Again, that's the process of the learning tool process as opposed to a advisory newsletter service on Fusion. And it's just related to married puts and collar positions in that case. Tell me that didn't just happen. Okay, yeah. So there we go. All right, well, it is 5:45 p.m. Eastern Time. It would have wrapped up probably 5 minutes, 6 minutes ago. I don't see any other questions. If I did miss a question, go ahead and feel free to send it in if I just skipped over it. But regarding, of course, some of those positions, I want to remind everyone in the free webinar section that options concepts, manage your broken position. Make sure you take a look at that. And the options strategy section, for Mark, I'm sorry, Mark, I just forgot the question there. There's that whole webinar on managing your naked put positions. Okay, it's long, but you can skip through it and find the ones where it talks about the ones that have declined. But we showed you today alternatives and ideas you could use to manage that AAOI put, whether you got put the stock, you can evaluate the stock repair tool, you could average down and then evaluate the stock repair tool, which will give you better results, by the way, or you can look at other opportunities there for just converting it to a covered call or a collar on the position. Okay, but remember, this is a public page. That link I sent everyone earlier, powerop.com/webinars.asp. Don't need to be logged into the position or logged into the account there. You can just go ahead, access that link at any time, and go through the different webinars. And all of our Friday discussions are listed here in the requested topics. So hopefully on Monday I'll get this one posted as well. You'll be able to review that. It might even be Sunday, but we'll see when that gets posted. Okay. Sam says, when to do a debit spread? I was waiting on Amazon. The stock dropped below the 50 EMA after 2 days bouncing from 50 EMA, 99-100 debit. Okay, so got out at $9.98, the premium from $2 to $7. Okay, well, it looks like you entered it when it hit, and you did the 990-100, and then it ended up at 998 on the debit spread. I'm sorry, 990-1000. And yeah, it was a bull call, 990-1000. You got out at 998, so it wasn't the full profit, but it was still a profitable position. And you used the 50-day EMA on that as well. Okay, so yeah, that's what we would you look at there. Now, the key is that the one thing, Sam, I know you know your stocks and you have your technical analysis and everything. When someone asks me, comes to me and says, I want to do a spread on Amazon, is now the right time? I'll flat out answer them no. The reason why is they're asking me, hey, I want to do a spread position, I want to do Amazon, is it the right time to do it? To me, that tells me that they haven't done enough research and analysis on Amazon to even consider if the strategy they're using is the right strategy for the stock. I know you're not that type, but believe me, I get this question at least 2 or 3 times a month. Someone focuses on just one stock that they want, and they want to know if they should trade a bull put on it. Well, if you don't know if you should trade a bull put on it, I'm going to tell you no, because you shouldn't be trading a bull put on it if you haven't looked at the stock deep enough to make sure it's a good position for a bull put. I'll show you the bull put combinations. I'll show you how to find them using PowerOptions. I'll walk through what the pros and cons are of those particular positions on one stock at a time. But if you're saying to me, hey, I really like, and it's not what Sam's doing, but it just brings to mind a question that came up earlier this last week that I didn't talk about on the webinar on Friday. A customer said, I'm really interested in, he wanted to do a bull put credit spread on Apple, and he says, but I'm really waiting to see this trend crossover. Should I do the spread? My answer was no. If your whole trading technique is based on it crossing over this indicator you're using, and it hasn't crossed over the indicator, then don't enter it, because that's what you're track record your trading plan is based on. And if you force it and it works, great. If you force it and it doesn't work, you know why it didn't work. But I can't tell you if there's any secret thing, and I know, Sam, you're not asking that. That was what the look was there in that one. I just brought that up because I thought it was interesting when someone asked me a question related to, hey, should I do this spread on this stock? I don't know. What normal stocks would you do that type of strategy on? Or if you've never traded that strategy before, let me know and I'll take a look at it. Okay? All right. Okay, so all that being said, let's just navigate back over here real quick. And there we go. Okay. Oh, nope, did that completely wrong. Okay, there we go. Sorry about that. Just remind everyone, of course, if you haven't done so already, go to PowerOp.com, put in your name and email address, and you're going to get the 14-day free trial without any billing or credit card information. Subscription levels after that, we've got the end-of-day service is $40 per month. The data is only updated at the end of the day. We do have a 20-minute delayed service in a real time, and we do offer back-testing tools that work with similar to the search tool we saw today in the search by symbol. The upgrade from the 20-minute delay to historical is just $40 extra per month, and then from the real time up to the premium. Again, other free stuff, you can check out our free webinars at any time. I showed you the link there. You can go to blog.powerop.com to see more of our blog information, or also check us out on our YouTube channel where all the webinars are posted as well. And then if you think of a question, of course, later on, send me an email at any time to support@powerop.com. Remember, you can also send an email to support@radioactivetrading.com if you have questions about radioactive trading as well. Remember, give us a call during market hours at 302-992-7971. Of course, those of you that are trial members or subscribers, you can schedule a coaching session at any time.